Hi and welcome. I'm Jim Cook, and this is my maiden voyage using Remo, but it looks like it's got some promise. I'm looking forward to seeing how it goes today. I want to thank our panelists for being part of this. So Cory and Julie and Kyle and Matt, I'll let them each introduce themselves and go through a little bit about their backgrounds. But the idea today is to share their experiences, their thoughts, their recommendations and suggestions about investing in early stage companies. So those of you who are in the audience that might be thinking about trying to raise capital, or actually out there right now trying to raise capital, or maybe even thinking about being a check writer and investing in some companies, hopefully there'll be some things along the way that will be of use. The format will be, I've got some questions for the panelists to react to, and that'll be the first portion. And while that's going on, encourage you, as Josh said, to submit the questions for the Q&A, because I'll then take a look at that. And then the last part of the presentation mode, I'll try to ask some of those questions to the panelists. And then very important, I think, at the end, as Josh mentioned, there's going to be a networking session. So each of the panelists will be available at different tables if you want to go and introduce yourselves or otherwise talk with the panelists. They've been gracious enough to agree to hang around for a little bit to do some of that. So with that, we'll get started. So I think what I'll do, Cory, I'll start with you and just ask you to give a brief background of your, kind of who you are, where you came from, and in particular, a little bit about what you're looking to invest in.
Awesome. Thanks so much, Jim. I'm Cory von Wallenstein, and I'm an active angel investor and advisor. I live in Bedford, New Hampshire. My background is as an entrepreneur, most notably as the former CTO of Dunn before it was acquired by Oracle. And since then, I've been a full-time angel investor and advisor, getting locked arm in arm with great companies, both here and abroad. So far, I have about 24 companies, not including the landscapers that are currently here mowing my lawn, if you can hear that in the background. But about half of the companies I work with, I'm very active with. I spend about a day or two a month with, about half are passive. My goal is to deploy between $50,000 and $500,000 of capital into a company, lock arm in arm for a day or two a month, and help grow that with that team into a great company, to a great exit. And really what I look for, my ideal stage is the team is formed, they have some initial sales, they have happy customers, and they're really thinking about how to grow it. And that's the best time for me to jump in and get involved. And I'm really excited to share some learnings and lessons with you guys.
Perfect. Thanks, Cory. Julie, you're on.
So I'm Julie Glosner, and I'm with the New Hampshire Small Business Development Center is my day job, and I'm the lead for the Northern New England Women Investor Network and the New Hampshire Women Investor Committee Steering Committee. So what we've done over the last few years is worked with Maine, New Hampshire, and Vermont to try to grow the number of women angel investors. So we've gotten success in getting more people educated and knowing each other in the 3 states, and we participate in some different deal flow as well. So I also work with entrepreneurs through my SBDC hat and help them find angel funding. And I have experience with healthcare and education, and worked in high tech as well before I started at the SBDC.
Good. Yeah, thank you. Kyle, you're up.
Great. Thank you for having me, Jim. I'm Kyle York. I'm the CEO and co-founder of York IE. We're a strategic advisory, investment, and operational growth firm. It's kind of a lot of words to say. We're trying to create a new model around early stage investing and helping lean in on go-to-market and growth, creation of brands, sales teams, organizational structures, pricing models. We predominantly focus on enterprise software space, but we'll provide advisory services to sort of any subscription-oriented, tech-enabled brand. We're very focused and very biased on doing things in New England, especially in New Hampshire. Our model's very hands-on, kind of like Cory's focus. And so we want to be able to, now in this day and age, get on Remos and Zooms, but in the future, hopefully, again, be able to hop in the car and see people a little bit more face-to-face. We run a syndicate model, so we don't have a traditional venture fund, but we have about 20 external investors who give us a 5-year pledge and an annual commit. And we're deploying right now in our evergreen syndicate about $6 million a year, and anywhere in the neighborhood of 10 to 15 startups per year. We go really early stage, Genesis stage through Series A, and we aim to help companies get on the growth path that we all aspire to. So excited to be here today and get to know you guys all.
Good. Thanks, Kyle. And last but hardly least, Matt. Oh. We'll get there.
I think you were saving oldest for last. Is that what you said? Most mature. Hey, so my name is Matt Pierson. I've been in the tech ecosystem for about 35 years at this point. I started a couple companies that were successfully acquired by much larger organizations. And beginning in 2006, we really turned a lot of my attention to promoting and helping sustain the tech ecosystem. Did that in a couple ways. One was serving for 10 years on the High Tech Council, now the Tech Alliance Board of Directors, and creating some new programs to involve entrepreneurs and connect them with capital. One was Product of the Year to get exposure for companies. And then the other was Tech Out, which actually has, in its first iteration, funded 12 companies that Tom Daly and I oversaw the investment over a period of 5 years. And that's gone on to be a bigger program now with the Tech Alliance, and funded even more companies at a bigger level. And also at the New Hampshire Charitable Foundation, founding the Entrepreneurs Fund of New Hampshire, which also connects entrepreneurs, but in this case, more with nonprofits that can utilize not only their capital, but their expertise. Day job, I'm a managing director at Dunn out of Boston. We help companies with an enterprise value of $20 to $250 million sell when they're ready to sell. And we work very closely with entrepreneurs who've been successful to see that exit that they've been working often for most of their life to achieve. And my specific focus there is technology, manufacturing, and anything related to defense organizations.
Good. Thanks, Matt. Hey, one thing for Josh. Josh, I don't know if there's a way to unmute all the mics for the panelists, but if there is, I think that'd be helpful. If not, I'll go around. Oh, good. Thank you. So my first question for you is 2020. Had kind of a cool ring to it coming into the year. It certainly has turned out a lot different than anybody ever expected. And I'm curious what you've seen that's different or similar. What's changed, if anything, in terms of the investment community? Opportunities, deal flow, structures, anything, any high-level comments about what's different with 2020? I'll pick on Kyle to begin with. Kyle, you were mentioning something earlier about your perspective on that.
Yeah, well, 2020, I'm also KYork20 on Twitter. It's my football number from growing up, so it's my good luck number. So, I still have a lot of hope in this year.
Right.
But, I think it's a fascinating dynamic where I actually haven't seen an incredible slowdown in the earliest stages of entrepreneurship. I think if anything, with remote work, you're seeing a dramatic shift in even the largest of enterprises adopting enterprise software and technologies that they wouldn't have if not forced to. After spending 3 years at Oracle after the Dyn exit, you realize a lot of these companies are very slow to move, and the digital transformation is incredibly hard at scale. And you're just seeing a massive acceleration that is forced upon us because of the pandemic. So in our world, which is, again, software focused and internet enabled services and technologies, it's been amazing to see how many new companies are getting created. Also, how many companies are seeing tailwinds to their businesses. Not every single industry, unless you're in hospitality or restaurants or travel or some major industries, are seeing the same types of headwinds in technology. Many are riding the tailwinds. And, I think Cory mentioned a little bit about the pivot kind of point and thinking through, that might have been before we were on, but the pivot point, a lot of these companies are trying to find those tailwinds and then ride those tailwinds, even if that means adapting their business models a bit. So we've seen acceleration. I actually find that we're far less distracted, even though I've got 3 children running around and we might see one today, who knows. I actually find we're far less distracted with, kind of less day-to-day minutia meetings, things that kind of take up your time. And it's been pretty pretty productive for our team to sort of come together and unify around our big vision here.
Good. Thank you. Anybody else? Anything special about 2020 so far?
I would say the biggest thing I've noticed so far is solid resilience. Resilience both in the companies that I'm already working with and the ones that are making pitches. No one's pretending like they can just get through this unscathed. Everyone has taken this to the core of their culture, how they operate the company, how they service their customers. And to Kyle's point, they're all looking for those tailwinds to be able to ride. The biggest question mark that I see for the deals that I'm actively looking to go into would be, okay, if you're setting up a sale to catch those particular tailwinds, how long are those particular tailwinds going to help you? And so those are the scenarios where you start to look, are people overreacting, or are they really on the right long-term track to what's going to happen? None of us have that crystal ball to figure that out, but being able to understand, like, is this a solid team who can identify this opportunity and be able to move forward? I mean, that's really the name of the game all in all, right? You choose which people you're going to hire to make money for you. And this is just a perfect kind of microcosm scenario to put, you basically watch people go through one of the hardest sort of either pivots or pitches or scenarios of their lives. And it really, really, the people who can do it really show off what they can do. And it's really been enlightening to work with people exhibiting that resilience. It's just absolutely eye-opening.
Good. Thanks.
I think for investors, it's a little bit challenging in one way, and that's that in the past, we always got to meet the management teams we're looking at investing in face-to-face, break bread, get to know them at a deeper personal level. And I think a little of that has been stripped away. I think it's even more important now for people to have a good digital presence, being able to communicate over digital platforms, get their message across. But it still makes me a little bit uncomfortable not being able to look somebody truly, eye to eye across the table. And I'm looking forward to when that day comes back, hopefully sooner rather than later.
Right.
I would say too, I think a lot of people are being very innovative, and the startups are very apt to being able to pivot and make a change quickly. And so you're seeing that happen more.
Good. Thanks. So,
Jim, real quickly to Matt's point, one thing that's been kind of fascinating, I found that we're doing way more back channeling on entrepreneurs in our investments than we ever did. It almost feels borderline sketchy, some of the behavior we're doing to get to people and understand their networks and who they've worked with, customers, partners, former employers, former employees. We just do way more of that diligence. To Matt's point of what you used to be able to get face to face, eye to eye, you wouldn't need to do that much behind the scenes and kind of stalking them a bit to just make sure you can vet that out and feel very confident going in. Because at the end of the day, we're all backing people, regardless of the idea, the IP, the traction. It's the teams that matter most.
Most definitely, yeah. So somebody comes to you, however they get to you. They pop you an email, they chat with you in the networking session today or otherwise. But what are your personal top three criteria that you use how would you characterize what the key things are? I've talked to different people and they have their own list of things that certainly people would be on there. But people need to, when they're trying to make a connection with you, intrigue you to talk with them more, what are some of the things that you look for early on to see if this is of interest to you, this opportunity?
For me, it really comes down to one thing. Can they sell? Can they sell? Can they sell? And that applies to not only just their customers, but also employees that they might hire, co-founders they might recruit, investors they might bring on. I've learned, having done this dozens of times now, that I can teach people how to build something, but I can't teach people how to sell something. And so that ability to convince either another customer or prospect or employee or potential co-founder or investor to jump onto a vision of what the future could look like and to be able to just lock arm in arm and ride that wave together, I can't teach that. I'm sure other people can, but I certainly can't. And so that's something that I look for to be kind of there at the table already, and then I can help coach and mentor on a lot of the other pieces.
Thanks. Anybody else?
I can give you a quick three. First of all, I want to know, why did you reach out to me? Was it because of a referral? Was it because of some industry expertise that you saw on my LinkedIn profile, or some other exposure? Then who do we know? To Kyle's point, you got to do some back channel investigation here. So who do we know together? How can I vet who you are, what you've done in the past? Have you really been successful? I mean, most people who approach me, the vast majority are legit, but there are some people who are, bad actors. And sometimes you have to peel back a couple layers to figure that out. And then the second thing I look for is, can the people communicate? Can they communicate to me what the opportunity is, what the market is, what their team looks like, what their plan is? And often that's a litmus test, because if you can communicate those things to me successfully, to Cory's point, I think you probably can communicate to your potential customers as well.
Good.
Yeah, I think what I would add is, we've kind of taken a very broad top of funnel approach to, we put out an incredible amount of content, curriculum, educational material to try to capture the hearts and minds of entrepreneurs, potentially future entrepreneurs, to sort of engage with us in the masses. So we've had to create a pretty rigorous process, like any sort of sales funnel, to convert through the pipeline to determine when and which we engage, right? And it's pretty hard to cut through the clutter and the noise as a firm, but also I think for the entrepreneur on the other side to find that match. So we've worked really hard on embracing technology and systems and processes to make that kind of inbound funnel no different than if we were selling them a product on the bottom of the funnel. For me, at the highest level, I think we like to take a market-in approach to our investment thesis. Most startups are founded by technologists. Most CEOs are engineers who can code and build something. I actually take a little bit of a different approach to Cory. It's similar but different in that we like to make sure they truly understand the market they're trying to enter and disrupt and be an innovator in. Many times, even at Oracle, I remember we got acquired for a handsome sum, and I remember sitting in one of the first meetings about what Oracle wanted to do with us, and I was mentioning names of comparators and competitors and adjacent spaces and markets, and executive vice presidents at Oracle had no idea what I was talking about, who I was talking about, who those companies were, which again is because they're product and engineering leaders product out versus market in. So I've always tried to take that backwards and inverse approach my entire career, and that's how we've really tried to cut through the noise in the top of the funnel and through our processes of where we decide to not even invest, but where we decide to even do discovery and diligence through a process.
Thanks.
Yeah, and I would add, we do try to understand, the business model that they're in. It doesn't really matter the industry, but also, is the team capable, like Cory said, can they communicate, can they sell, but also are they able to grow the company to get the margins and growth that we're looking for?
Yep. So talk to me about how you value a company. So you found somebody, then you kind of like what you see. They're asking you to write a check. Well, how do you decide what value to assign to that company? The pre-money valuation, if you will, and maybe also, if you would, talk about how you, at a high level, how you like to structure a transaction, an investment transaction, if you have a preference. But for first, value. How do you come up with a value?
I'm happy to answer that. Unfortunately, in the majority of sort of cases, this is one thing that we've been dealing with at York IE. We're averaging about a $600,000 check into startups today. And so depending upon the size of the round, we actually may not be the lead investor in the round. So we may not actually be able to set the value. I think we because of our model being so hands-on and that market-in approach, we can be super influential in how the startup thinks about the pre-money valuation and the rest of the terms that come with the close. But I think you really only are able to set true value when you're the lead investor and you're the biggest check in a round, which is an interesting dynamic we're dealing with right now as we add new investment partners to our syndicate model so that we can get our check sizes clearing $1 million and then being able to lead those $1.5–2 million rounds with the largest check. With all that said, there's sort of like just benchmarks when it relates to early stage companies, whether they're pre-revenue, whether they're a couple $100K of revenue, whether they're clearing $1 million. There's just sort of benchmarks and ways to look at that that obviously need to be backed by the team, the market opportunity, the product IP moat, traction, and all those things. But it's really all over the place. I think it's incredibly exaggerated that those things have contracted in COVID. I haven't seen a change whatsoever. If anything, the only change might be when people need like a bridge round because they can't go raise their next round. Those are the only deals that I've seen maybe valuation constrain or constrict. But mostly, I think it's relatively based on benchmarks and like peers and, what the founding team thinks they can get. And then it's a good old fashioned negotiation.
Okay, I'll hold on that for a moment. Let somebody else chime in, but lots of follow-up stuff for that. But go ahead. Anybody else want to chime in with how do you, if you're the lead on a transaction, how do you value the company? What do you use to come up with a number?
Well, I think what Kyle said about benchmarking is really true, because if you look at a lot of deals, you see where other deals are getting done for other companies that have similar profiles in the stage of growth. I would add that if you're a successful entrepreneur and you have 2 or 3 successful exits under your belt and you've got a good team around you and you've got a legit business plan for this new venture, you're probably going to be able to drive a little bit higher valuation in the early rounds than if you're brand new to investing. So I think past track record can really help bump up the values a bit. I would also say that a lot of the deals that do get done in the early rounds are not priced at all. They're going to have a convertible note and they punt putting a value on that company till later on when there's more history, when there's a better track record of being able to make sales, get customers, drive some revenue, prove out the product. And in a lot of cases, that's beneficial to the entrepreneur, because when you're pre-revenue, it's really hard to assign a high valuation to something that's not driving revenue yet. But if you can get to that 1 million ARR, annual recurring revenue, or be on actually just on the trajectory to get to $1 million in recurring revenue, your valuation might be 3-4 fold what it was when you were pre-money, but you had that same product concept and team around you.
Okay.
So something that I've been doing a lot more research on is the revenue-based financing or royalty-based financing. And that's something that I think a few investors I've spoken to recently are interested in, where it values, it's a growth stage company or, middle to growth stage. So 20 to 25% growth. But then they're not fixing a value so much on the company, but on what the revenue is and deciding what rate of return they want. And then, each deal is different, but that is something that doesn't require an exit as far as selling the business. So it's beneficial for the company and beneficial for an investor. The rates of return are a little bit lower, but so it's not really a value. Kind of like what Matt was saying, it's you wait and see what the revenues are, but usually a company has to have at least 500 to 750,000 in revenue. So not a pre-revenue, usually around for a year or 2.
Yeah, good. Yeah, that structured type of investment as opposed to maybe an equity investment. Cory?
Have anything new to add? I think those answers were all great. I do notice the Q&A stuff. If I could, I want to answer a couple of these because these actually look like really good questions that are popping up here. So what are some current examples of tailwinds and how you see companies riding them? This is a great one. I mean, you talk about like remote work right now, just things that used to be done in business that either had paper involved or people interacting face to face. Now you just can't, right? But though that work needs to get done, anything that kind of fits that. So you have like these legacy industries that were sitting around just, doing stuff over paper because they could. They didn't have any reason to change. Well, guess what? Now there's a forcing function where they have to change. So probably the one company in my portfolio that fits this profile the most is a company called Simple Charters, which is basically a platform for booking private aviation. And this is something that was always done over PDFs and emails and phone calls and quotes. And people just are, and just like touring stuff in person and knowing who has what. And that just isn't happening anymore. Everything is now just, I want to be able to click a button and be done. And so this is a company that's now, quadrupled their sales since the beginning of the pandemic. And so that's an example of a tailwind behind that company. And I have other companies that were, one was a wedding venue company, right? There's no weddings happening. That is a headwind, right? And so now they're basically in a holding pattern until they can, until this kind of resolves their situation. And the next one that I saw here that looked really good, they kind of popped down. I think it was on what prevents a company from going from early stage to mid stage to late stage. Number one thing I see there is lack of repeatability. You have early sales that require a high touch, high engagement with customers, high integration. And when you go to ramp that up from, $1 million a year to $10 million a year, you discover that you can't repeat that as easily. You either need more people, or the technology doesn't scale, or the problem just doesn't have that level of demand. But repeatability means scalability. And by definition, to go from early to mid to late, you're basically saying you're getting bigger. Well, if you're going to get bigger, you better get repeatable. So if your sales are not repeatable, they're not ready to scale, whether it's limited by the market or limited by your onboarding or limited by the product itself. So those are the two that jumped to my mind real quick, and I wanted to answer real quick, Jim.
Yeah, no, that's fine. That's good. Well, I'll start to weave some of those in. So one of the questions that was asked by the audience is, what are some of the attributes you're looking for with startup founders? So I think Cory's answer is sell, sell, sell. But any keys there in terms of, and Matt mentioned the bit of a track record. Anything in particular? Otherwise, you'd like to note.
I think for me, if somebody comes in and makes a 30-minute pitch, which is pretty typical in like an angel investor meeting, when they get challenged by the people who are looking at making an investment, how do they handle the tough questions? Do they keep their cool? Do they have a rational response? Do they get agitated? I mean, I like to see how people perform with a little bit of stress, not a ton of stress, but a little bit. And just get a general sense of how do they do? Because being an entrepreneur is, it can be stressful. There will be periods of great stress, even in the most successful new ventures. And I think being able to react to that and handle that well in the normal course is really important to me.
Thanks.
I'm going to follow on. We call it coachable at SBDC. Are the entrepreneurs willing to listen? Are they defensive, like you said, or will they adapt and can make changes? Because, Cory does this all the time. I'm sure if he's meeting with people once a month, he's giving them his recommendations, and hopefully they're taking it to help grow the company from your experience. So.
Good. Kyle, any?
I mean, nothing more to add really in the sort of investment side of that. I mean, I think those are really great points. I think once you start to work with a company, then you start to get to like the sort of grit, resolve, perseverance, like optimism, all those sort of character attributes that like just are required, because there's no straight line up and to the right in startup world. I mean, a lot of the successes look so glamorous, and they get the top TechCrunch headlines, and you read about them in HBR. But I mean, Cory and I can attest, like the Dunn journey was not always fun and not always easy. There was lots of casualties, friends along the way who had to move on or decided to bail. Growth isn't easy, and it comes with a lot of pain. Scaling pain, cultural pain, takes a lot of resolve. So I think, those are the things you try to suss out, you try to background check, you try to challenge people in the pitch meetings to see how they handle it and how they bob and weave and dance on their feet. But you only really know those things when you start to see kind of macro crises like pandemics and micro crises like, a new hire quits on you or something, right? I mean, stuff bad happens every day in a startup. So it's kind of that resolve and persistence and optimism that I think we all look for.
Good. One of the other questions from the audience was, where are you all? Where are you sourcing your deal benchmark data from? So I kind of let you guys.
I'm from Kyle.
Yeah. I'm still letting you guys off easy talking about benchmarks. So give some.
Yeah, hold on, would you guys? This might be a pitch. We are eventually going to launch York IE Fuel, which is our market data and analytics platform.
Yeah.
That we're currently working on in house. No, but I do think, that data is basically all over the place. I mean, a lot of the tier one venture capital firms like Benchmark, Bessemer, Andreessen Horowitz, Battery Ventures, a lot of these major firms are always putting out different types of data on different types of sectors. So I think there's a lot of that benchmark data. I think, honestly, talk to your attorneys, your CPAs, your advisors, entrepreneurs who have done it before. They'll sort of guardrail you in some of those discussion points and decisions. But I think that a lot of those places, we've actually seen also a massive shift in like operating metrics and people's transparency to share private companies to share their financials, their performance metrics, their KPIs far more than maybe they were a decade ago. I certainly know that the stuff that Dine held close to the vest, there's stuff that companies now put out there for all to learn from, which is not how it always has been, I don't think, in scalable businesses. So lots of good places. And follow York IE. I mean, we definitely put a lot of it out because it is hard to find if you don't know. So, I think getting it out there is only helping more entrepreneurs become great entrepreneurs.
Good. Thanks.
Yeah, we like to talk to lots of people, right? So we like to talk to other individual angels, angel groups. Kyle and his organization look at 250 deals a year, or more. And we compare notes. One thing about the ecosystem in Southern New Hampshire, at least, is we're not competitive. We're collaborative when it comes to getting deals done. And if we see a deal that doesn't fit our tech profile, but we think Julie might be interested or know other people who might be interested because it's out of our area, we want to be helpful to every single entrepreneur that crosses paths with us. We want to learn from them. We want them to learn from us. So we're willing to share all the information that comes our way.
That openness is probably a good point as well. I don't know how often you guys would sign NDAs, but I think people who are trying to raise capital need to appreciate the fact that there's a lot of conversation among the investor community.
I have never signed an NDA before doing a deal. And I'm very upfront with I'm going to be asking questions to your customers, to your friends, to the people that work with you on what it's like to do business with you. And I'm just very upfront about that.
Yeah, that's good to know. Thank you.
Extremely rare. I would not say never. I signed one this year.
Okay. There's another question here, which I think really is related to convertible notes. It says there's been talk about a 20% discount in valuation. Is this valid? Anybody want to address?
If that's related to pandemic, I have not seen like a universal percentage you could apply. Everything's situation based. Basically, companies that got caught on the wrong foot, they're in trouble. And they take a valuation hit because they either take cash or they go under. And I've also seen the vice versa. When the tailwind is in their favor, it can command a valuation premium. So it's not to say that there's a universal haircut. It's really situation based.
I would add, I think there were 4 weeks from mid-March to mid-April where that may have been true because people really didn't know where we were heading. And there was fear of this huge liquidity gap in terms of capital needs and capital availability. And I think the deals that I looked at for that 4-week period, there was distress in the air. And I think that was quickly overcome by the infusion of capital into the markets in general and the sharp rebound in the stock market, which, a lot of angels, they've got a big chunk of their portfolio is in the market and they got a lot more confidence back. And that helped to prevent this global collapse in deal valuations. I would say I've seen in the one area, back to the tailwinds, if you're in what we would call the healthy living segment, if you're a specialty juice manufacturer, vitamin, probiotic manufacturer, online exercise, purveyor, those areas valuations have actually gone up, not down.
Good. Hey, Julie.
I did see where Airbnb, though, when their value from 2017 to now is down quite a bit, 41% from as they get ready for their IPO. They struggled.
I think it's tricky to look at the Silicon Valley darlings. I mean, you would have had to have invested in Uber in 2014 to be in the black today. So I think it's really hard to look at the private company, rocket ships like the Airbnbs and the Ubers, even on a good day, right? I mean, those economics are really, really tricky and challenging. I think one thing, Matt, I was going to add on your point too, Matt, was like, no one started a fundraising process if they didn't have to in March through April. The ones who were in one and needing to close one, I think maybe had to step back and say, okay, I'll take a haircut because I need the capital. Right. I know a lot of funds who just went into triage and basically said we can't look at anything outside. So it wasn't like they were haircutting anybody because they froze all net new investments just to make sure their current investments were healthy. And in some cases might have topped off and done sort of inside rounds at better deals. But I think, like to Matt's point, it was very short-lived, 4 to 6 week period where it was sort of like very dodgy. And definitely people didn't want to move their money, right? When the markets were down, if you were an individual angel investor, people did not want to log into their brokerage account, pull cash out to put it in the riskiest asset class on the planet, startups, right? They waited and then they determined their portfolio asset allocation.
Different topic. What have you seen in terms of the number of female founders who are pitching?
I would say I think that there are more women that are getting into pitching and that they are getting more funding than in the past, for sure.
Yeah, I've seen a trajectory. I think 3 of our last 5 deals have had women founders on the executive team. I think 2 or 3 were CEOs. That was honestly a concentrated effort of York IE. When I looked at my historical angel portfolio of 60 companies before I left Oracle and started York IE, it was incredibly non-diverse. Not by choice. I think just by network, tech, software. I don't know, but incredibly not diverse. It was also very passive. We were building companies. I think York IE, the benefits of a firm and doing it full time is you can really look at all the different demographics, diversity of your portfolio, and kind of put a little bit more emphasis and focus on that. But I've definitely seen more women and minorities in founding teams. And I think there's just more support out there and more organizations out there to support that hopefully positive trend.
Okay. How do you see the early stage investment landscape changing over the next 5 to 10 years? For example, more deals moving to online platforms like AngelList or WeFunder, maybe the round size or valuation trends. What's your crystal ball tell you?
I'll go quickly. The funds have gotten way too large, and the funding rounds have also gotten way too large because of those funds being so large. I think you will see, what's the definition of a pre-seed round, a seed round, a seed extension round, a Series A round? What is the definition anymore? These things have gotten far bloated. So I think you're going to see, hopefully, a lot more of a back to normal, back to life, back to reality on these round sizes and also on the valuations. I think more and more companies are going to need to be focusing on, at least in technology, on the notion of potentially path to profitability or some level of operating margin in the future. They're not all gonna be the Ubers and the Airbnbs who can burn. What did I see? Palantir burning 500 million a year or something in their S1. I mean, that's just asinine. Those are outliers, people. And I think the overall Silicon Valley venture capital markets have overcorrected to try to turn everything into power law and everything into an outlier, when really great companies can exit for 25, 50, 250. You don't all need to be unicorns. So I'm hoping that we see a little bit of that course correction, at least in the earliest of stages.
I totally agree, and that's certainly where I'm putting my money where my mouth is, because I see the mid-market opportunity as being the one that I can directly impact and see a sizable return from. I'm not interested in creating unicorns. Those are the outliers. And at the end of the day, I can always be outfunded by someone when I'm going after those deals as just a one-man show. But when there's a company who's trying to make a material impact in a vertical industry, and they're doing something 10 times better than what the competition is, then yeah, there's a real opportunity there to build a great $25 to $250 million company. And that's a model that I can rinse and repeat. So I certainly expect to see that continue. And I expect, it really depends on what interest rates do, right? Because for the last 10 years, or so, we've had nowhere else, there is no alternative to equities. And we've seen that continue to push into private equity. And who knows if we get a rapid interest rate shock, what we'd expect to see in terms of dollars getting deployed in these riskier assets.
Good. There's a question here that I'm going to broaden a bit. It talks about founders and their incorrect expectations on how often to pitch before finding the right fit. I guess my higher level question that this would be part of would be, what are some of the top mistakes that you see founders make when trying to raise capital?
I think.
Oh, go ahead.
Go ahead, Julie.
I was going to say,
Julie.
sometimes they go too early and they're not ready yet for getting the capital, but they try to do it pre-revenue, or they need to wait a little bit, get some more experience under their belt, and then go out and try to raise funds.
I would say some investors that we've seen, or some entrepreneurs, come into a meeting and think that 10X, as an example, is the firm that's going to invest in them because they've read everybody's background and it's just an ideal fit, and therefore it should be a slam dunk. And that's just it's a mistake. Often what happens when you're pitching people is it's a single personal connection that you make amongst the members of a particular angel group. And then that person believes in you, and then they evangelize, the other people who are members of the group, or one or two of them, and then they will touch with somebody else in another angel group. But you need to talk to a lot of people. The expectation going in should be, I'm going to talk to anybody and everybody who I have a rational should have an interest in this plan. I'm going to research the background of those individuals in those angel groups, and have a rationale of why they should pay attention to me. You need to think through more of those personal connections and recognize there might, on paper or on the website, look like a perfect fit, but there could be lots of other reasons why that person who you think is perfect for you won't make an investment. It could be timing. It could be, they've already got existing investments in that market space, and they don't want to be over concentrated in, let's say, ed tech. As an example. So you need to cast a broader net than most people look at. Jules Pierre, who founded the Grommet and ultimately sold to Rakuten, she had to talk to 50 VC firms before she got her first yes. 50.
Here's one thing I'd like to add that I think is specific to the New Hampshire startup scene. So the Tech Alliance throws a great event that I really like called the Speed Venture Summit. They've been doing it for several years. I used to always hear as we were building Dine that there's not an investment community in New Hampshire, or, good investors find good companies no matter where those companies are, right? Dine's investors, the Borealis was a small investor with us, but Dine's investors were not from the state of New Hampshire. I think it's important at the Speed Venture Summit now, it's packed with investors coming up from Boston, investors coming up from all throughout New England and even the Northeast. We need more good companies and more good entrepreneurs. And it's a little bit of a chicken or egg problem. But many of the startups that we met with there, for example, were moonlighters, right? The founders were moonlighting. They weren't going all in on the startup idea. It was very difficult for us to consider committing to an investment if they're not even committing themselves to the company. And I think that's just a hard truth of startup life. At some point, you need to dive in, and there's major sacrifices that need to be made to compensation, financials, all those things. But most entrepreneurs are not going to get funded if they're not 2 feet in 100% of their time, taking the risk.
Good. Another question. Do you consider positive social impact at all in your investing?
I can answer that. Considered, but not. You're not going to do a deal because of it. I think it's the same as the diversity point. It needs to be things you look at. You want companies to be well-rounded. You want them to be thoughtful about community and give back, social good causes, some altruism. But at the end of the day, it's not why you would do a deal. It might encourage you or push you in the direction, but it's not. I don't think it's a major factor. And honestly, I think many times, and you saw it with Tom's shoes, you've seen it in lots of different arenas where it's kind of a little bit of a farce, and it's not as social good as you'd hope it would be.
Yeah, I would echo all of that. I'd also say that a good social impact is having a successful business that employs a lot of people.
Yeah.
Don't lose sight of that fact.
For Impact New Hampshire Fund, that was something that the criteria, one of which was, a woman in the C-suite, and then, if they had some social impact, but not, the deciding factor for sure.
Is there a right amount of equity to sell to investors in a seed round? What are your philosophies when it comes to check size in that early round?
This one. So I think this is more a function of understanding your milestone. Like from where you are, where do you need to get to next? And then what does the next look like after that? And so from where you are, if you're a single co-founder or a single founder, you have no one else in the team, your next milestone is really like, can I recruit kind of my core camaraderie to help build this thing with me? And I need some amount of capital to kind of explore that. And, those terms get labeled. There's certain rounds, whether it's pre-seed or so on and so forth. Or you might be, I have my initial sales. I've sold, $100,000 of this. And now my next milestone is I want to sell $1 million of it, right? Really understanding your current milestone and your next milestone is the prerequisite to thinking about what size round and then what percentage of the company should that roughly represent. Because these are going to be totally different depending on where you are. And going back to the talk about valuation, it depends on who's in it, where it is, who's advising it, who's connected to it, what do your initial customers say? There's so much that comes into picking out these numbers. Usually when I work with folks, I really help them hone in on what these milestones are. And then we could pull in benchmarks to look at, okay, here's what other people did when they were at your milestone, going to your identified next milestone. And here's what they had to sell in terms of percentage of company or what their valuation was. But at least if we can nail those two down and have good understanding about that, we know roughly how much capital we're going to need to raise. And then we can kind of figure out what that represents of the company to get to that next milestone.
Jim, this touches upon your question earlier around preference in equity, notes, safes, all that. This is becoming an absolute nightmare in early stage tech, where entrepreneurs are using the Y Combinator, safes, and then convertible notes, and they're stacking them on top of each other and laddering up valuations. There's a deal we're putting $550,000 in right now. Great company. We'll announce it in a few weeks. That because of all the note conversions, they're actually diluting 50%. Right? this seed round is not a 50% dilution, but all the notes stacking up and now converting to preferred equity are diluting common shareholders 50%. Most startups are super flippant about this until they raise an equity round. We actually are pushing really hard, and again, this comes with size of check and leading rounds and all that, but to move back to real life, which is preferred equity rounds, it's not that much more complicated to go do it and make it happen and do it the right way and get everybody kind of aligned on the preference stack and towards the right cap tables.
Interesting. Yeah. Thanks.
I would agree with all of that. The one thing I would add is, as I look at valuations and how much equity is being given up, I always want to see how the ownership team is going to use equity to compensate everyone else to attract, retain, recruit new talent that they're going to need to execute their business plan. And that should be factored in up front. And if it's not there, if they haven't thought through that, then that's a bit of a warning.
So thank you. So seeing Josh pop up, which is kind of a signal to me that we need to wrap this soon and go to the networking. But there's one question which I think is kind of fun that I've got to ask. And it says each investor generally has their strengths, their own strengths. Some are sales, some are distribution, some management, et cetera. What are each of your strengths that a prospective founder should take into account in taking capital from you? What are your personal strengths?
I'll go first. I'm fundamentally a product person. Where I excel is when people have identified a core pain in the market, and that pain is going to get bigger with time, and they have a 10 times better way to make that pain go away. I can help them think through how do we make those customers happy now, and then scale up a business to make them happy in the future. Mostly from kind of a product self-service perspective, but also in terms of, well, how do we communicate this thing? How do we talk about it? How do we educate a market that this is now the right way to do it? So I would say product leading up to marketing, but stopping short quickly from there.
Good. Somebody else?
I'll jump in. So in my background, especially at DTC, I was always the bridge between the engineering tech team and the marketing and sales team, which in total was, when I left, 75 people. And being able to kind of translate the engineering tech ideas into marketing sales and backwards from marketing sales back into the engineering team, and be the voice of the customer in that role. But that bridge is pretty critical in growing tech organizations.
I would say I do strategy more. I like to help companies when I'm working with them think about where they are. Cory mentioned this earlier too, pivoting, where they are now, where they want to go, and trying to help them get to that next level.
Good.
Yeah, I would just add, we're kind of a unique egg. I'm obviously sales marketing background, but my two partners, Joe Raska was Dine's first head of FP&A, and then also our head of corporate development and strategy. And then my other partner, Adam Coughlin, was our first and only head of corporate comms, and then ran product comms and product marketing at Oracle Cloud. So we sort of try to bring this sort of growth and go to market together. So both from capital needs, financial modeling, scaling, all the way to brand building and go to market initiatives. So it's kind of across the gambit, but all with that flavor of that market and approach I talked about earlier.
Good. Folks, thank you very, very much. Cory, Julie, Kyle, Matt, it's been great. There are questions that we didn't get to, but there's a networking session coming up. So those of you who have some of those questions, make sure you track some of these folks down and ask, and otherwise, do a bit of chat. But thank you very much. Appreciate your time.
Yeah, thank you, everybody. And Jim, thank you so much for really helping organize this event today and being really thoughtful as a moderator and bringing all of us in line. It's a fair amount of work. And just before we jump off, I want to do a quick shout out to our sponsors. So you might realize and know today we're sponsored by Cook Little Rosenblatt and Manson. And what's important also to note there, and I want to do a shout out, is that they're one of what we call at the New Hampshire Tech Alliance a TEP, or Tech Ecosystem Partner. And what that means is they write us a really big sponsorship check every year. And there's only really a handful of companies that sponsor us on that level. And that's been a real stabilizing force for us, the Tech Alliance, and allowed us to keep our programming and do events like this. So first I want to say thank you, and it's really genuinely appreciated. And also to shout out at this particular event, which doesn't happen that often, especially for a small event, we have 3 different tech ecosystem partners here at the event today. I see the York IE logo that Kyle's sporting here as well. So thank you to all of our tech ecosystem partners. We literally couldn't do any of the things that we do without you, and we really greatly appreciate it.